for loose tools. So diminution in value for loose tools. That is a capital allowance. And we are talking about loose tools. We need to know what are the loose tools. So loose tools include these are the loose tools we are talking about: spanners, pliers, screws, screwdrivers, bolts, utensils, etc. If you look at those items, we consider them to be small items. Screwdrivers, spanners, pliers, utensils. That's why loose, small items. So for them, they qualify for a capital allowance. They qualify for a capital allowance called diminution in value. The rate is 33.33% in bracket a third of costs per annum every year for the first 3 years, after which it is stopped. Yeah. So take note of how different that capital allowance is, that we normally give at the rate of 33.33. If you convert that into a fraction, it's a third of the cost per annum. Per annum means every year. So you take a third, first year, second, third, for 3 years, after which it stops. That it is not on a reducing balance. All the other capital allowance we have looked at, from the investment deduction, industrial building deduction, wear and tear allowance, farm work, mining allowance, all those we said they were on a reducing balance. This one is kind of straight in 3 years, and then it is stopped. Because by the time you get to the third year, since it's not on a reducing balance, you'd have taken 100% of the cost. Having taken a third first year, third second year, third year, then the whole cost is considered. So in that case, you stop and you don't continue claiming the diminution in value, even if you continue using that particular item. So that is the last capital allowance that we have. And we have now looked at all the capital allowances that are usually claimed in the business for capital expenditure that are incurred in the business. So this one brings us to the end of this topic of the capital allowances. And now we move on to the next topic, which now, remember, the key topic is about the taxation of the business income. Only that we said we are doing some introduction to the taxation of the businesses. And whatever we are doing is laying the foundation of the taxation of those businesses, which we said we need to look at 2 businesses, the partnership and the limited company. So when you looked at the methods of determining the taxable income, non-taxable, allowable, non-allowable expense, and capital allowance, all these are the foundations.